A big options expiration week, $5 trillion in options expiring in the latest so-called triple witching session that just concluded. That market event coming the same week as the Fed's decision to cut interest rates and an S&P rebalancing. So what's the best way to play it? eToro U.S. investment and options analyst Bret Kenwell joined us now to discuss in the Options Playbook, sponsored by Tasty Trade. Thanks so much for being here. So, we had this enormous event today. Now that it's done, what do we see over the course of the session that can inform where positioning was and where it may go from here, Bret?
Sure. Today was one of the big four expiration dates of the year for when it comes to the options market. And, I think you kind of saw that action leading up to today's session with so much back and forth. And we had a late day pop in stocks. And, that a lot of that plays into the expiration. But I think what's really interesting is when you look at the seasonality. So you look at seasonality in September, it tends to be pretty bad for U.S. stocks. And, when you really dial into that seasonality, you see a lot of it comes in the so-called back half of mid-month, which to, an options trader's ear, you hear the third week, which is, right around the monthly OPEX. And so, I think that leaves the door open at least to see some choppiness, some profit taking, or some outright seasonal weakness kind of going into the end of quarter. But, that's short term. That's the next, we have 10 days till the end of the month and, a few weekends in between. So it's really only a few more sessions. I think longer term, bigger picture, it still looks pretty constructive for equities.
Let's dig down and get into some sectors, Bret. I know you expect strength in tech, for example. How come? Walk us through that.
Yeah, so, a few months ago, we were looking for strength from, some of the less loved, under-owned sectors. Utilities was a big one, and it's become a great performer. And a few others have done great as well ahead of the Fed's, finally they've cut rates. And, a lot of sectors performed well into that. And it's been great. It's great to see. It's healthy to see, improved breadth. It's healthy to see better market participation, more sectors joining the party. But, kind of tech has sort of fallen by the wayside amid all this, breadth expansion. Suddenly it's gone from, the favorite stocks, the leadership group, to being, I think it's the fourth or fifth best performer on the year, when it comes on a sector by sector basis. And so, the S&P and the NASDAQ, they all rallied really hard into mid-July. They topped out, and we've had good amount of volatility since then with, the carry trade imploding and whatnot. But, you look at the Dow, you look at the S&P, they've both found a way to get back to all-time highs. And you look at the NASDAQ, and it continues to lag. And that's despite, many of these names being household names, despite being investors' favorite stocks, despite them being the biggest stocks in the market. And, I think in the fourth quarter, we probably see a little bit of a rotation back into some of these names and some of these, Magnificent Seven, large cap tech. I think they start to play catch up.
And so from an options perspective, what are some ways that people could get into that if they also agree that tech is going to catch up?
From an institution standpoint, early this month in September, we had that, I won't say minor dip, but it was certainly minor compared to the one we saw in early August. And into that dip, we saw a lot of, put sales into some of the Magnificent Seven names or a lot of the semiconductor leaders. I don't know that that's necessarily the best way for a retail investor to play. Probably a more reasonable way to play at this point would be, probably by either buying calls or if they want to reduce that cost and limit their upside a bit. Call spread would be a great way to get into it. Something where they have a defined risk. They know what they're, they know the net debit. They know what they're paying, and they're not going to lose more than what they put into it. So probably calls or call spreads would be a great way. And if they don't want to pick individual names, that's completely fine. You have the QQQ ETF. You have the XLK ETF. Both of those names should do well if tech picks up in Q4.
If you expect strength in tech, Bret, are there sectors where conversely, you'd be looking for weakness here?
I think that it wouldn't be surprising if we saw some of those, like utilities I mentioned earlier, or real estate. Both those names have done really, really well lately. I wouldn't be surprised if we saw a bit of a sell the news type of reaction in those names. But we have to remember, too, they were depressed for so long, and now we're seeing sort of these catalysts line up for them, and rates aren't just a one-off rate cut that we had on Wednesday. We now have a path to lower rates. And I do think we can actually keep some of this breadth expansion alive and keep some of these other sectors going, which is a great thing. That's what we do want to see. That we don't want to go back to, the first half of 2023 where it's basically the Magnificent Seven and, maybe Eli Lilly, the Magnificent Eight doing all the heavy lifting. We want to see a number of sectors doing the lifting, but we could see a sell news reaction on some of the more, the hot sectors lately.
Bret, always good to have you on the show. Thank you for joining us.
Yeah, thanks so much.